Welcome to the video. Today we'll unpack a high-stakes retirement decision that can trigger a surprise 5-figure tax bill. Moving pre-tax pension or 401k money into a Roth or taxable brokerage account. We'll walk through what goes wrong, what to do instead, and how to compare a lump sum to a guaranteed monthly pension. Let's begin. Here's the roadmap for today. First, we'll define the core mistake of mixing tax buckets. Next, we'll review the tax buckets themselves. Then, we'll quantify the tax hit with a real example. After that, we'll show the smartest move, the direct rollover. We'll then compare lump sum versus guaranteed income, followed by a quick comparison table and 2 quizzes. Finally, we'll wrap up with key takeaways and a succinct summary. Before we get into details, this video is educational only and not individualized tax, legal, or investment advice. Retirement and tax rules can change and vary by jurisdiction. Your situation is unique, so consult a qualified fiduciary financial advisor, or CPA, before making decisions. With that said, let's move forward. Let's start with the core mistake. Most employer pensions, and many old 401k US, hold pre-tax dollars. Moving those funds into a Roth IRA or Roth 401k is treated by the IRS as a taxable conversion. Likewise, moving them into a standard taxable brokerage account is treated as a taxable distribution. In both cases, the entire amount is added to your ordinary income for that year. By contrast, a direct rollover into a traditional IRA or traditional 401k maintains the pre-tax status and defers taxes. Now let's clarify these tax buckets so the difference becomes crystal clear. To understand the consequences, we need to understand the tax buckets. Pre-tax accounts like traditional IRAs, traditional 401ks, and most pension lump sums defer taxes until you withdraw in retirement. Post-tax accounts, namely Roth IRAs and Roth 401ks, require you to pay tax now but provide tax-free qualified withdrawals later. Taxable brokerage accounts have no special tax shelter. Dividends and gains are taxed along the way. The golden rule is to avoid mixing pre-tax money with Roth or taxable accounts unless you intend to pay taxes immediately. With that foundation, let's quantify the potential tax hit. Consider a concrete example. If you convert a $100,000 pre-tax pension lump sum into a Roth account, the entire $100,000 is added to your taxable income for the year. This stacks on top of your salary and other income, potentially pushing you into higher brackets. While administrators often withhold 20%, your actual marginal rate could be significantly higher. That leaves you with an additional tax bill due at filing. Similarly, sending pre-tax money to a standard taxable brokerage account is treated as a distribution and taxed as ordinary income immediately. To avoid this, use a direct rollover, which we'll cover next. To avoid the immediate tax hit, request a direct, trustee-to-trustee rollover into a traditional IRA or your current employer's traditional 401k. Make sure the check is issued to the receiving trustee for the benefit of you, not payable to you personally. Then confirm the deposit and pre-tax status before you invest. Finally, allocate the funds according to your investment plan and risk tolerance. With the mechanics clear, let's analyze the strategic decision between taking a lump sum and choosing guaranteed monthly income. When it comes to a defined benefit pension, you're often choosing between a lump sum and a guaranteed monthly payment. The lump sum offers control, flexibility, and potential for higher returns if invested well, along with better legacy planning. On the other hand, taking the monthly benefit provides guaranteed, zero volatility income that can reduce sequence of returns risk and help ensure essential bills are always covered. The right approach begins with a comparison. Evaluate the plan's promised monthly payout against plausible returns from investing the lump sum. Crucially, if you select a lump sum, have your traditional IRA or traditional 401k lined up beforehand to receive a direct rollover and avoid taxes. On the left, the lump sum offers investment control, the possibility of higher returns, and better estate flexibility. However, it introduces market volatility, behavior and timing risk, and demands a disciplined withdrawal strategy. On the right, the monthly payment provides guaranteed lifetime income, reduces longevity risk, and simplifies planning. But it can lock you into less flexibility, may offer limited legacy value, and may not fully keep pace with inflation depending on cost of living adjustments. Balancing these trade-offs depends on your risk tolerance, goals, and other sources of income. This table summarizes the common rollover paths. Pre-tax funds, such as a traditional 401k or pre-tax pension lump sum, should be rolled into a traditional IRA or traditional 401k via direct rollover to avoid current taxation. Moving pre-tax funds to a Roth is a taxable conversion and adds the full amount to your income for the year. Moving pre-tax funds to a taxable brokerage is a taxable distribution and should be avoided if you're trying to defer taxes. Roth to Roth rollovers generally aren't taxable if the rules are followed. Quiz time. You roll a $100,000 pre-tax pension lump sum into a Roth IRA this year. What happens? Option A. No immediate tax. It's tax-free because it's a retirement account. Option B. Only earnings are taxed. The principal is tax-free. Option C. The full $100,000 is added to this year's taxable income. Option D. Only 20% is taxed because the plan withholds that much. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is option C. A Roth conversion adds the entire converted amount to your ordinary income for the year. Any withholding is simply a prepayment toward your total tax liability. It does not limit or cap the final amount you owe. Second quiz. Which action best avoids immediate taxes on a pre-tax pension lump sum? Option A. Direct rollover to a traditional IRA. Option B. Deposit the check into a taxable brokerage within 60 days. Option C. Take the check payable to you and then send it to a Roth IRA. Option D. Convert to Roth during your highest income year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is option A. A direct, trustee-to-trustee rollover into a traditional IRA preserves the pre-tax status and avoids immediate taxation. By contrast, depositing funds in a taxable brokerage, taking receipt of the check personally, or converting in a high-income year can all trigger tax right away or at an especially unfavorable time. Here is a quick reference using simple markdown. First, the golden rules. Keep pre-tax funds with pre-tax via direct rollover. Expect full ordinary income taxation when converting pre-tax to Roth, and never send pre-tax funds to a taxable brokerage. Next, a checklist before electing a lump sum. Have a traditional account ready to receive a direct rollover. Make sure the check is payable to the trustee for your benefit. Confirm the deposit and pre-tax status, and model cash flows versus the monthly pension benefit. As an added tip, ask your advisor to compare the plan's monthly benefit to a prudent withdrawal rate from the lump sum after fees and taxes. Now, let's crystallize the key takeaways. Here are the key takeaways. First, identify which tax bucket your money belongs to, and keep rollovers within that same bucket. Second, use direct, trustee-to-trustee transfers to maintain pre-tax status. Third, understand that pre-tax to Roth conversions are fully taxable in the year of conversion. Fourth, never roll pre-tax funds into a taxable brokerage if your goal is to avoid immediate taxes. Finally, weigh the control of a lump sum against the certainty of a guaranteed monthly benefit when shaping your retirement plan. In summary, mixing tax buckets leads to avoidable, sometimes large tax bills. If you want control without an immediate tax hit, use a direct rollover into a traditional account. Compare lump sum versus guaranteed income using realistic return assumptions and your risk tolerance. And, as always, consult a fiduciary advisor or CPA before you act. Next, let's close out. Thanks for watching. If this helped you avoid a costly mistake, please like the video, share it with someone who's considering a rollover, and subscribe for more clear, practical money guides. Finally, we'd love to hear from you. Would you choose a lump sum or a guaranteed monthly benefit, and why? Share your thoughts in the comments.